Hello, friends! We are going to revise the complete book of economics with important points in just 20 minutes. So, without further delay, let's get started. First is features of microeconomics. Now, let's see the features: study of individual units, price theory, partial equilibrium, limited scope, based on certain assumptions, slicing method, use of marginalism principle, analysis of market. Next is importance of microeconomics. First is price determination, second is free market economy, third one foreign trade, fourth is economic model building, sixth is business decisions, next is useful to government, and last one basis of welfare economics. Now let's see features of macroeconomics. Study of aggregates, income theory, general equilibrium analysis, interdependence, lumping method, growth models, general price level, and policy oriented. Let's see importance of macroeconomics. Functioning of an economy, economic fluctuations, national income, economic development, performance of an economy, study of macroeconomic variables, and last one, level of employment. Now let's see the features of utility. Relative concept, subjective concept, ethically neutral concept, measurement of utility is hypothetical, utility is multipurpose, utility differs from usefulness, utility differs from pleasure, utility differs from satisfaction, utility is the basis of demand. Utility depends on the intensity of want. Now let's see types of utility. First is form utility, second is place utility, knowledge utility, service utility, time utility, and possession utility. Now let's see the assumptions of law of diminishing marginal utility. That is assumptions of law of DMU. Rationality, reasonability, divisibility, cardinal measurement, homogeneity, continuity, constancy, single want. Now let's see the exceptions to law of diminishing marginal utility. Hobbies, miser, addiction, power, money. Types of demand. There are five types of demand: direct demand, indirect demand, composite demand. Fourth is complementary or joint demand. And fifth is competitive demand. Now let's see the reasons justifying downward sloping demand curve. First is law of DMU, that is law of diminishing marginal utility, income effect, substitution effect, multipurpose uses, new consumers. Now let's see determinants of demand. That is the factors affecting demand. Price, income, size of population, advertisement, prices of substitute goods, nature of products, state, taste, habit and fashions, level of taxation, prices of complementary goods, expectations about future prices, and other factors contains climatic conditions, changes in technology, government policy, customs and traditions. Now let's see assumptions of law of demand. Constant level of income, no change in size of population, no change in taxation policy, prices of substitute goods remains constant, prices of complementary goods remains constant, no exceptions, no expectations, no expectations about future changes in price, no change in tastes, habit, preferences and fashions, etc. Exceptions of law of demand. Giffen's paradox, prestige goods, speculation, price illusion, ignorance, and habitual goods. Now let's see variations in demand. It occurs due to the change in price. First is expansion of demand and second is contraction of demand. Next is changes in demand where price remains constant but other factors changes. First is increase in demand and second is decrease in demand. Types of elasticity of demand. First is income, second is cross, and third is price. That is income elasticity of demand, cross elasticity of demand, and price elasticity of demand. There are three types of income and cross elasticity of demand: positive, negative, and zero. And price elasticity of demand contains perfectly elastic demand, perfectly inelastic demand, unitary elastic demand, relatively elastic demand, and relatively inelastic demand. Now let's see the methods of measuring price elasticity of demand. First is ratio or percentage method. Second is total expenditure or outlay method. And third is point method or geometric method, which contains linear demand curve and non-linear demand curve. Now let's see factors influencing elasticity of demand. Nature of commodity, availability of substitutes, number of uses, habits, durability, complementary goods, income of the consumer, urgency of needs, time period. Importance of elasticity of demand. Importance to a producer, importance to government, importance in factor pricing, importance in foreign trade, public utilities, and proportion of expenditure. Now let's see determinants of supply. That is factors affecting the supply of product. Price of commodity, state of technology, cost of production, infrastructure facilities, government policies, natural conditions, future expectations about price, and other factors contains first, nature of the market, second, relative prices of other goods, third, import and export, fourth, availability of factor of production, fifth, industrial relations. Now let's see variations in supply. First is expansion and contraction. And changes in supply contains increase and decrease. That is increase in supply and decrease in supply. Variation in supply occurs due to the change in price, and change in supply occurs due to the change in other factors. Now let's see the assumptions of law of supply. First is constant cost of production. Constant technique of production, no change in weather conditions, no change in transport cost, prices of other goods remains constant, no future expectations about price, no change in government policy. Now let's see exceptions to the law of supply. Supply of labor, agricultural goods, urgent need for cash, rare goods, and perishable goods. There are three types of cost and revenue. First is total cost, average cost, and marginal cost, and total revenue, average revenue, and marginal revenue. Market is distributed in three types: place, time, and competition. Place has three types: local market, national market, and international market. Then time contains very short period, long period, and very long period. Then competition. Competition contains perfect competition and imperfect competition. Imperfect competition contains monopoly, oligopoly, and monopolistic competition. Now let's see the features of perfect competition. Homogeneous product, large number of sellers and buyers, free entry and exit, single price, no government intervention, perfect knowledge of the market, absence of transport cost, and perfect mobility of factors of production. Now let's see types of monopoly. First is private monopoly, for example Tata Group. Public monopoly, for example Indian Railways. Third is legal monopoly, contains Amul products. Fourth is natural monopoly, which contains wheat from Punjab. Simple monopoly, that is same price for all the customers or buyers. Discriminating monopoly contains doctors charging fee according to the standard of living of their patients. Voluntary monopoly contains opaque. Do comment if you want video with small and important explanation with one or two points that we have to write in that sub point. Okay, now let's move further. Features of monopoly market: single seller, price maker, complete control over the market supply, no distinction between firm and industry, that is no difference between firm and industry, no class substitute, barriers in entry, price discrimination. Now, features of oligopoly: few firms or sellers, interdependence, lack of uniformity, advertising, entry barriers, and uncertainty. Now, let's see the types of index number: price index number, quantity index number, value index number, and special purpose index number. Now, features of monopolistic market. Monopolistic market means the market with various brands of liquid cleaners. First is fairly large number of sellers, fairly large number of buyers, product differentiation, free entry and exit, concept of group, selling cost, close substitutes. Significance of index number in economics: framing suitable policies, studies trends and tendencies, forecasting about future economic activity, measurement of inflation, useful to present financial data in real terms. Now let's see the features of national income. Microeconomic concept: value of only final goods and services, net aggregate value, net income from abroad, money value, financial year, flow concept. Importance of national income for the economy: national policies, economic planning, economic research, distribution of income, comparison of standard of living. Methods of measurement of national income: first is output method, second is income method, and third is expenditure or outlay method. Output method contains final goods and final product approach, value added approach or value added method. And expenditure or outlay method contains private final consumption expenditure, that is C, gross domestic private investment expenditure I, government final consumption and investment expenditure G, net foreign investment or net product exports, net receipts R minus P, that is research minus payment. Now let's see the theoretical or conceptual difficulties in measuring national income. Transfer payments, illegal income, income of foreign firms, unpaid services, production for self consumption, valuation of government services, changing price level. Now let's see practical or statistical difficulties in measuring national income. Problem of double counting, existence of non monetized sector, inadequate and unreliable data, capital gains or losses, depreciation, illiteracy and ignorance, difficulties in the classification of working population, valuation of inventories. Next point is structure of public finance. It contains public expenditure, public revenue, public debt, fiscal policy, and financial administration. Public expenditure contains revenue expenditure, capital expenditure, developmental expenditure, and non developmental expenditure. And public revenue contains tax and non tax revenue. Tax revenue has two types: direct and indirect. Direct tax are divided into three types: proportionate tax, progressive tax, and regressive tax. And indirect tax contains GST, that is goods and service tax. And non tax revenue are divided into various types: fees, prices of public goods and services, special assessment, fines and penalties, gifts, grants and donations, special levy, borrowings, etc. Public debt have two types: internal debt and external debt. Financial policy. It contains public expenditure, public revenue, and public debt. Financial administration, that is revenue expenditure and debit policy for overall growth. Now let's see the types of budget: balanced budget, surplus budget, and deficit budget. Financial market contains two types: money market and capital market. Functions of RBI: issue of currency notes, banker to the government, bankers bank, custodian of foreign exchange reserves, collection of publication of data, promotional, promotional and developmental functions, controller of credit reserves, and other functions. Indian financial system, financial institutions, financial markets, financial instruments, and financial services. Now let's say organized sector. It contains RBI, that is Reserve Bank of India, commercial banks, cooperative banks, development financial institutions, discount and finance house of India. Now let's see unorganized sector. It contains indigenous bankers, money lenders, unregulated non-bank financial intermediaries, which contains Nidhi, CHIT funds, loan companies, etc. Functions of commercial bank: acceptance of deposits, demand deposit and time deposit, providing loans and advances, ancillary functions and credit creation. Next is role of money market in India. Short-term requirements of borrowers, liquidity management, portfolio management, financial requirements of the government, implementation of monetary policy, economizes the use of cash, growth of commerce, industry, and trade, equilibrating mechanism. Next is problems of Indian money market. Dual structure of the money market, lack of uniformity in the rates of interest, storage of funds, seasonal fluctuations, lack of financial inclusion, delays in technical upgradation. Next is Indian capital market. It is further divided into four types: government securities, industrial security market, and development financial institutions, and last is financial intermediaries. Industrial securities market contains new issue market and old issue market. Development financial institutions contains IFCI, ICICI, FFCs, IDBI, IIBI, and UTI. Financial intermediaries: merchant banks, mutual funds, leasing companies, venture capital companies, and others. Role of capital market in India: mobilizes long-term savings, provides equity capital, operational efficiency, quick valuation, and integration. Problems of capital market in India: financial scams, decline in the volume of trade, inadequate debt instruments, lack of informational efficiency, insider trading, and price manipulation. Foreign trade contains import trade, export trade, and entreport trade. Next is role of foreign trade. First is to earn foreign exchange. Second is encourage investment. Third is division of labor and specialization. Next is optimum allocation and utilization of resources. Next is brings reputation and helps earn goodwill, availability of multiple choices, stability in price level, etc. Now let's say the same trends in exports: engineering goods, petroleum products, chemicals and chemical products, gems and jewelries, textiles and ready-made garments. Okay, now this is the conceptual clarity for types of price elasticity of demand. There are three types we can say for our easy understanding. First is perfectly, and then is unitary and relatively. Perfectly elastic demand and perfectly inelastic demand. Perfectly elastic demand, where zero or small change in 0% or a small change in price results into infinite change in demand, where elasticity of demand is unlimited. And here the graph is horizontal line parallel to x-axis. Next is perfectly inelastic demand, where 20% change in price results into 0% change in demand, where vertical straight line parallel to x-axis is the graph. For example, salt or milk. Then unitary elastic demand, where elasticity of demand is equal to 1 and where slope of curve is rectangular hyperbola and rise in demand is equal to fall in price. Then next is relatively elastic demand, where elasticity of demand is greater than 1, where demand is greater than change in price, and relatively inelastic demand, where elasticity of demand is less than 1, where change in demand is less than change in price. Thank you so much for watching this video. Bye bye.